how do you get financing, right? So there's talk about two sides of financing. There's the debt side, which is a bit of volatility in the debt. We all know that. But then there's investor sentiment. How do you go raise equity today when people are just like, whoa, like there's so much uncertainty. It's too much risk here, and perceived risk. And it's my job to, make sure that investors understand, well, how am I protecting your investment? And how is this a better investment?
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henschel. Welcome back to The Path to Wealth. Today we welcome Reed Goossens, an expert in helping investors from overseas making sense of the US real estate market. He's the host of the Investing in the US podcast, originally from Brisbane, Australia. He found his own American dream when he came to the US over a decade ago. Having worked in real estate for over a decade, he's well versed in many aspects such as real estate development, syndications, and asset management. And he's a pro at capital raising. With over $680 million assets under management, he's someone to watch in our industry. Welcome to the show, Reed.
Hans, thank you so much for having me.
Of course. In our industry, I think you're truly one of the ones to speak to when it comes to international capital. And maybe you give us a little bit of the backstory of how you started raising capital from abroad and, how you help investors make sense.
Yeah, so the thing was, when I first got started here back in 2012, I realized some of the benefits as I was going through the learning process myself. It was like I needed to share some of the tips and tricks that I was discovering here in the US about investing in secondary markets or tertiary markets, or buying properties for $30,000, Section 8 housing. Like this was back in 2012, so there was a lot of interest from abroad in American real estate, as there is today still. But in terms of the Australianness, in way I would sort of speak, and if I open my mouth, I have an accent. So I started a podcast back in 2014 around investing in the US. And it was really just the first 10 or 12, 20 episodes is just my sort of step-by-step guide of what I was learning. What's an LLC? What's a cash on cash? What does EIN mean? How do I get my money into the US? And all the things that I was just learning as an expat being here, but I was boots on the ground. And so that was in 2014. And you can see the book behind me, Investing in the US, The Ultimate Guide to US Real Estate. That came from that. There's another book next to it called 10,000 Miles to the American Dream. And it just sort of documents my journey in and around what I was just discovering being an investor myself. I sort of, from a branding point of view, I thought, well, I'm sure other international investors would love to talk about this or hear about it. Why not I speak to them? And so that's where Investing in the US came from. It started with being very niche on international investors. Today, the majority of my investors are actually American. Given foreign exchange volatility, it's sometimes the average investor from Australia or Europe or Canada or England, they just can't stomach that volatility. But in general, it's the same basis. What I teach here, what I have taught to international investors here. I still have a nice portion of my investor base who continually repeats invest with me, but they're investing a large sums of money. And they're keeping the money here, right? It's sort of like a nest egg for them. They're not trying to take it back and forth to their home country where they could get eaten alive with their foreign exchange rates and stuff like that.
Yeah, I think you're making a crucial point there on the foreign exchange. And I mean, sometimes you benefit from it and sometimes you lose. We just redistributed some money to Europe right after the conflict between the Ukraine and Russia. And that was vastly beneficial for us, but we could have never timed that. We could have never planned for that. And, it could have also gone in a completely different direction. So that's really something to keep in mind. So at what ticket size do you think this starts making sense? You said that the investors they're planning to have that nest eggs. Where do they start? And at what ticket size you think going through the hoops of setting it up in the US, it actually makes sense for the individual investor?
Look, I think it's got to be multiple hundreds of thousands of dollars. I don't think it's $1 million, but I think you're looking between $100,000 to 300 grand to get started, because particularly if you're trying to, and I should probably take a step back, if you're trying to be an active investor and buy your own deals, i.e. turnkey properties, stuff like that, then there's going to be limited financing for you because you're an international person, right? You're probably going to be required to put 40 to 50, maybe even 60% down payment to buy, a triplex or a duplex, or you might have to buy it all cash. So it really depends on what your end goal is there for your investment thesis. If you're coming in investing more as a passive investor, you can then, the barrier to entry of those deals are obviously a little bit different. They're a lot smaller, but again, you're not having to qualify for debt, but you probably still want to do the $200 to $300, $400, $500,000 to, and leave it here for a period of time. Don't just come and think I'm going to take it back in a year. Come and do multiple deals. Maybe think of it like a 7 to 10 year horizon. I've got an investor from Australia. She used to own a trucking company. She invested with me way back in 2015. She's still invested with me today. And she's redoubled up, like with the 1031 exchange, the deals that we've exited with her, she's gone again with the same cash. So it's like, it just keeps growing upon itself here. And then she'll take that back in maybe another 5 years' time. And in that time, she probably would have been invested here for 15 years, and she would have taken a small amount of money, and then it's grown over that time, and she'd be able to take it back to Australia and not have that foreign exchange risk. It's sort of it's the coming across once and it's the going back once. Other people also use it like they come over here and they use it as a bit of holiday money, right? They come to the US and go to Disneyland with the kids, or they go to Florida. I don't know where they go skiing, and they use the cash flow in that bank account to fund their holidays here in the US. So it just depends on what you want. And I started with those smaller folks, but now I've skewed more to the larger people who want to bring in big check sizes to make it worth their while. So,
yeah. So what does the general setup look like? Let's say I'm coming over from Europe or from Australia. What do I need to do as an investor to get set up? And do I need to go there in person, or is this something that I can do via a lawyer maybe that's sitting in New York who is executing on my behalf? How do I set myself up so that I can potentially become a passive investor with you?
Yeah, look, the big thing for me as a sponsor is I don't want to take someone's money directly, right? I want to get them to set up here. One of the beauties about the US is that you can have an LLC set up and owned wholly by an international person. So unlike in Australia, where I've just actually opened a business back there, or an LLC back there, equivalent of an entity. I had to get my sister who lives there to be the chairman, right? Because you needed someone local. So here in the US, you don't need that, right? So you can, so you get, the process is step one, you've got to set up an LLC. Step two, you've got to go and get obviously the EIN number, and both those steps can be done by a lawyer. Step three is probably the bank account, which is the hardest part of getting set up. Sometimes you can do a power of attorney with certain groups that allow you to set them up on your behalf. But 9 times out of 10, people are going to want to see a physical body, right? They're going to want to see who's this person, so it's not, because obviously the US is really concerned about money laundering, right? And rightly so. So that hurdle has always been challenging, and most of my international investors do end up coming to the US for a holiday or something, and they tackle a bit of business. They open up a couple of bank accounts, and once it's open for forever, right? So you don't have to it's a one and done type of thing. Then from there, you obviously want to fund the bank account. That's when foreign exchange comes in, and there's plenty of foreign exchange companies out there that you can choose from to bring the money into the US legally. And then from there, you're ready to go and invest. And you can invest on your own, as I said, as an individual, or you can start investing passively into syndications, which is what I allow people to do. So depending on the path, will depend on subsequent steps that we can get into, depending on which way they go.
Yeah, that sounds like a little bit of a hurdle. I mean, I know not everybody is quite ready to fly over and open a bank account, but I think overall it's pretty straightforward, and there's nothing here that really scares off a sophisticated investor once they wrap their head around it.
That's right. And I think the only thing about that, Hans, is that if you're depending on the draw or the lure, and I don't know enough about Germany real estate to sort of speak out the side of my mouth, but at least when I compare it to Australia, commercial real estate in general, but given the financing system here in the US, is the most attractive and best yield producing commercial real estate in the Western Hemisphere, in my opinion, right? Obviously there's going to be certain nuances to deals that you come across in Germany or Australia, but in general, like multifamily, for example, which is what I do, 250 units, garden style, Central Texas, I couldn't go buy that in Australia. It doesn't exist. It doesn't exist in Europe. It doesn't exist in, Canada. So other things do exist, hotels and storage and warehousing, but, specifically to the niche that I focus on, which is value-add multifamily, that doesn't exist in Australia. So those are the things that people then look for yield to say, okay, well, why would I accept a 7 or 8% yield in Australia when I could get a 12 to 15% in the US? And okay, I'm going to get a little bit more serious about that, and also then have my my dollars in American dollars. You also got to understand that there's other countries, maybe not necessarily in the Western Hemisphere, but more developing countries, places like China and South Africa and India and Mexico and Latin America. They just want to get their money out of their home country's currency, right? Because they're worried about the failure of that economy, and they want to be backed by American dollars. So there's different ways and why you'd want to bring your money into the US, and depending on where your lens is coming from, we'll then look at, I just want to get my money out of from this dictator that's in my home country. Well, you don't really care too much of what the return is. You just want the money out so you don't lose it, right? So it's capital preservation, right? Where you're looking at someone like Australia or from Germany, for example, they're looking maybe on return on investment. So it's, again, two different lenses that they're looking to why they're exiting or why they're bringing money into the US.
Yeah, I think you made a great point. I also spent a significant amount of time in the last couple of years in India, and it's quite astonishing how fast the rupee loses in value. And okay, the last couple months, or it didn't look so bad compared to the rest of the Western countries because inflation was so bad. But over the last decade, it's just like taking away people's wealth without them even realizing it. So that's a true concern. And I think that's a great point you're making, that this is a legit reason to look for investments overseas.
And it also diversification, right? That's the major reason that those people are doing that. And I invest back I'm starting to invest back in my home country, right? So it's taking some of my proceeds from here and spreading the chips around the globe is not a bad thing either. So I think you do the same thing, Hans. So with being here in the US and back in Germany, so it has a diversification aspect as well that that you also have to understand. It comes with a lot of benefits of doing that.
Yeah. I also spent quite some time trying to understand the German market, given that I started investing in real estate overseas first. Then I came back. My family owns some real estate here. Then I wanted to look for what we consider multifamily in the US. What you just said. Like I cannot find those 250 units that we buy in Texas. And then I also noticed one thing. Almost everything I look at has negative cash flow, and they're trying to sell it to me with a smile. They're like, yeah, after 25 years, you own the thing. And I'm like, why would I do that? Like over there, I'm making money the moment we purchase it.
Right. That's right. Yeah. So go back to that yield thing, right? And that's where, I don't know if do you believe in my statement of the US being the best yielding commercial real estate? Would you agree with that statement in the Western Hemisphere?
Western Hemisphere. I think I can sign up on that, because everywhere I looked at from Europe, and I looked at it in India too. I spent some time in Mumbai, and the funny thing is that the Indians in America, after enough study and a lot of conversations, basically told me, just go back to the US. Just stay where there's money to be made, but it's not worth the headache. Stay in the US. That's basically, I spoke to hundreds of Indians that live in the United States and try to do business in India and doing business in the US. And it's basically the similar outcome. And I looked at a lot of different properties and concepts here in Germany. And obviously we were not finding the same returns that we have in the United States. So yes, I very much, I can sign off on what you said.
Right. What about even like, you look at like an office tower, right, in New York City, right? If you're, and I'm literally drawing a long bow here, but say it's a 4 cap, and I don't know if it's a 4 cap. Let's just assume it's a 4 cap. Well, you go and compare it to Sydney or Tokyo or Hong Kong or London, there are 1 and 2 caps. Well, you're going to go and you get better financing here in terms of, non-recourse debt, interest only, blah, blah, blah. Like that looks a hell of a more attractive deal, where to the average American, maybe a 4 cap's not necessarily that great, So that's why, based on your point of doing business and the access to capital here, why you get a lot of international money coming to the US, because they see what they've got in their home country, as you're saying, like the negative cash flow from day one, and they're like, why would I even do this? I'm going to put my money in the US. So, which has been, since I've been here a decade, a ton of international capital continuing to flow into the US. So yeah.
Would you say that leads to pressure in the market, makes deals overpriced? And I think, like, right now we're in a contraction phase. Prices are going down, but like 2 years ago or 18 months ago, pricing was so hot, and people like you and me, we're attracting international capital, which kind of puts oil on the fire.
Mm-hmm. I completely agree that in terms of the contraction phase we're having right now, in terms of your question around, do I think it's adding to it? Well, I also think you've got to think where you're coming from. I remember when I first started in buying assets, you could pick up things for $20,000-$30,000 a door. Like you couldn't build it, right? Like it's coming from, and that price to rent ratio compared to the other Western countries was so low that it just had so much to gain, right? So we now think, okay, yeah, the pricing is really, really hot, but maybe we're not thinking it from the wrong perspective. Maybe these parts of the US, like the Dallases and the Phoenixes and the Austins and the Charlotte, are transitioning into these markets where that ratio between value to rent is aligning a little bit more with, say, an LA or a New York, which would be similar to a Hamburg or a Sydney or a Brisbane or something like that. So they've just also, where they've started from was really, has come a long way as well. Now, I'm not an expert because I've only been here 10 years. Does it go back? But I see it very, very difficult. Like, I remember buying my first property, and a 2-bedroom renovated would cost you $750, $800, right? Today, that same 2-bedroom is $1,400. I bet you, it ain't going back down to 800, right? So, and I bet you over the next 10 years, it's going to get even more expensive. There will be a ceiling there for sure, but the point is, it just started from such a low basis that we're seeing stuff swing up to sort of more normal value for real estate if you look at it and compare it to the rent to value ratio, and you compare it to other Western countries. And that's the point I'm trying to get to.
Yeah. You mentioned one thing also is construction, and one of the things I noticed where I see a stark difference is construction substance. And I mean, you're familiar with that, given your personal history in real estate. Is the way I look at multifamily real estate or construction in general, the US has, the way they build is just a lot less solid. And sometimes I'm wondering, because when I look at a German, even a larger apartment complex, it's built extremely solid. Like most of those will be around in 100 years unless we tear them down. But if I look at multifamily construction in the US, I can't really say that, because I don't know, I feel like a couple heavy storms might just knock some of those down. And I have actually seen that happening when Hurricane Sandy hit New York, because I was in New York and the whole coastline was flattened. Just the old buildings that were like 100 years old that actually had stones were still standing. And all the newer construction was flattened out.
Yeah, the thing that I'll say to that is the US builds a lot in wood, right? 2 reasons for that, in my opinion. 1, subsidies, huge subsidies, and lobbying by the wood industry to make it the cheapest product. 2, out of all the products, so you got wood, concrete, steel, it requires the least technical labor. So you have a lot of the labor force to build out of wood. You have a greater pool to pull from than you do with concrete and steel. Concrete and steel will require it's not the right word, but I'm going to say more sophisticated way to build buildings. Now, you're in New York City and building high rises. Stick frame buildings can only go so high, right? It's typically 5 stories. Once you get above 5 stories, you have to go concrete, or you have to go podium, then stick, right? But you're correct. Yeah, there's when I look compared to the average single-family house built back in Australia, we'll use sort of CMU block, cement masonry block units to build the walls. There'll be some wood in the interiors, but not the entire thing is built with wood. And it's very much, in my opinion, it's obviously a lot driven by the lobbyists. But secondly, I think is also driven by the fact of access to labour, because it is the easiest material to build out of. Cut it on site. You can, where you stuff up a steel beam measurement, you can't just cut it on site. So there's it's a different way of building. And you're right, it is cheap. It's cheap, and it won't stick around for hundreds and hundreds of years. It's stick with a bit of stucco boxes, as they like to call them. So yeah.
Yeah. I mean, how do you feel about, like, I usually, now that I'm in Europe right now as we're recording, visiting my family, and I really appreciate how solid buildings are, and that if I sit in a room, I cannot hear what's next door. And I think that's one thing that we're lacking in the complex. So obviously, as an investor, I love the financial viability of what we're doing. But sometimes I feel like I wish there would be more substance to those properties when it comes to the walls, and I've been there in New York too, where I could hear my neighbors. I'm like, I feel like that wouldn't be like that overseas.
Yeah, different. Like my house that I live in right now is built as a colonial style house. It's built in 1912. The walls are still standing. I had to put a new roof on it. I didn't have to replace too much of it. Wood can last a long time. But you're right. It just doesn't feel. It feels ticky tacky, I think, is what you're trying to get at, compared to some of the substance. That's also a historical, viewpoint of how, like, you look at, say, the Northeast, New England, Boston, old places, old downtowns, Chicago's. They are actually built very similar to European style buildings, right? Some of the most beautiful architecture, even downtown LA has some stunning architecture that's very European-esque. It wasn't until the boom of the modern, industrialized world where America, particularly after World War II, really took off in that sort of the mass production of housing to try and, because they're just the baby boom, right? So it comes probably with a little bit of history, tied in there, where, say, somewhere in like Europe where it's just been around for more centuries, they haven't understood the wood type of construction. Thus, they just didn't think about it. So, yeah, I don't quote me on that, but I'm sure there'll be some validity to some point of all of, history has to play a role in that, particularly if you look at older cities in the US, because there is hallmarks of European style architecture and buildability that, you can say this is built really, really well.
Yeah. I just remembered one technical aspect to the overseas investor is how do they usually have to deal with taxation?
Well, that's the part that I mentioned earlier. The reason you start an LLC is so I, as the sponsor, are not having to withhold taxes from the individual, but then you're just treated like any other LLC here in the US, and you have to file your local, you'll get given a K1 if you're invested passively, and you'll have to submit, US taxes based on that entity. You also, depending on how you want to approach it, you don't want it flowing through to you back in your home country, right? You'll have to, I won't give you advice on that, but you want it maybe contained to the US. So it's a non-flow through entity. There's different ways you've got to think about that, how that then impacts your income back home. And also depends on if the US has a taxation treaty with your home country, like Australia. We do have a tax treaty, so it's sort of treated like a global tax, and this tax in the US is offsets in Australia and vice versa. So, again, you'll have to have a CPA here in the US, which we can help you with, but you also have to have a CPA in your home country to understand what the ramifications are, and if you want that flowing through or not to you in your home country based on your income status and what else you're trying to protect.
Yeah, and obviously this is not legal or tax advice. This
Correct.
is solely for educational reasons. So please find your own CPA and lawyer.
That's right.
Yeah. So, Reed, what are you, as an operator, as somebody who is actually getting syndications under contract right now, even in this market, what are the indicators that you're looking at, given the overall contraction and all of the noise that we're hearing? You know, there's a lot of uncertainty. How do you personally handle that as an operator?
Yeah, look, it's tough, right? It depends on where you bought your deal. If you bought in the last sort of 12 to 18 months, which we have, you know, interest rates have gone through a 500% increase. You know, it's unprecedented, and you know we didn't underwrite to that. You know, you got rate caps and all that sort of stuff in place, which is okay, but they're only okay for a certain extent, particularly on floating rate debt. So I think what you have to understand, and what I try to communicate to my investors, particularly on older deals that maybe have floating rate debt, is that like we're in it for we're now maybe your time perspective. You know, I think in the last sort of 5 to 6 years, there's been a lot of flipping of multifamily. You know, coming in 2 years, you flip it, you double people's money, you move on. Historically, real estate has been a long-term investment, right? And it's make money over the long term. I remember coming from Australia. If you double your money in Australia in 10 years, you're doing just fine, right? We got so used to making a quick buck here every 18 months that people are like, oh God, I've got to wait 5 years now to double my money. It's like, I'm so burdened by that. And I don't get cash flow because of, you know, the unprecedented raises in interest rates. Well, that's just part of the economy. Like, I can only control what I can control, right? Which is my asset. I can't control outside factors like the economy and or what the Fed decides to do, but I can also react that way to make sure that I'm trying to, you know, protect my investors' capital, right? And still believe in the fundamentals of real estate, that, you know, this isn't going away. Affordable housing is a problem here in the US. It's a problem across the globe right now. We've also got an inflationary problem, right? Which we think may be coming to the crack in the wall may have started with, you know, as of this recording, SVB went under, and so did a second bank, Signature. So, you know, the second biggest bank fail in US history, which is a real concern, and people are wondering if this is contagion in 2008 2.0. But we still need to be investing for the long term. So I'm still deploying capital this year. I'm still picking up assets. I'm picking up an asset right now that would have traded at a 4 cap a year ago. It's now trading at a 5.5 cap. So technically you could say I'm picking up at a 25% discount on a price per pound compared to assets that sold 12 months ago. That's a good number, right? Like, go pick that up. The problem is now, with, you know, right now in the belly of the beast, as we record this on March 14th, is how do you get financing, right? So there's I'm talking about two sides of financing. There's the debt side, which is a bit of volatility in the debt. We all know that. But then there's investor sentiment. How do you go raise equity today when people are just like, whoa, like there's so much uncertainty. It's too much risk here, and or, you know, perceived risk. And it's my job to, you know, make sure that investors understand, well, how am I protecting your investment? And how is this a better investment than, say, the stock market? Or when you compare it to other alternatives that are out there. And that's where you've got to have that conversation. And investors then realize, well, yeah, I'm investing in hard assets. In high inflationary environments, people flock to hard assets to protect the erosion of wealth, right? Which is, you mentioned it with the rupee before, when the dollar becomes cheaper, your value of a dollar reduces compared to, say, 10 years ago. So investing in physical assets will always still be the prime motivation for a lot of people, including myself, in today's high inflationary environment. But I do start to see the beginning of the end of the rate hikes, and I still, you know, with the new CPI data just came out today, or like today, it is starting to head in the right direction. I don't know how long the Fed will keep interest rates high, but I do think, you know, if we had this podcast in 12 months' time, I think we'll be sitting in a different interest rate environment than we are today, probably less than what we are today. I don't think we're going back down to zero just yet, but I think we'll be coming off the pedal.
I'll set myself a calendar reminder to check on this one, the prediction. But there's one interesting thing about going through cycles. Like, I generally refer to the last 10 years as like the golden decade, because interest rates have been so cheap. It's been like a frenzy, you know. And I mean, for some time we had negative interest rates in Germany, which is like, that's like hard to wrap your head around. And if you now zoom out beyond 10 years, you know, actually the interest rates that we have right now look pretty normal. Like if you go into 2, 3, 4, 5 decades, we're sitting as a fairly competitive interest rates. Like when I compare what we have to pay right now, what we consider expensive, looking at from the last maybe 36-month, 48-month perspective, when I compare that to what my dad had to pay when he started purchasing real estate, it's actually quite competitive still.
Yeah, it's very cheap. But the problem is I think it's the quickest increase in the rate of increase, right? Going from 0 to 5% is 500 times. Back in the 70s,
Yep.
Volcker went from, I think it was 11 to 22%. So it's a double, it's still 11, 22% is insane, but it's double. It's not 5 times. So you also got to remember where we're coming from. Yes, there has been cheap money and people have gouged themselves on it for the last 5 or 6 years, including the US, including the fiscal spending of what's the debt here in the US is, it's they printed more money than they have done ever or something like that. Some weird statistics. So I'm not an economist. I'm not pretend to be an economist. I think I see it harder. I don't see a scenario where you're going to 11 or 12 or 13 or 14%. I just don't. I don't see how that doesn't cause a lot of worldwide issues for developing countries who borrowed in US dollars, and for how the US can pay its own debt back with when the debt service payment has just quadrupled. So I don't see it rising that high. Outside of particularly what's happened right now, and I think there's been a lot of economists that have said, including Powell, we need time to let this this fivefold interest rate going from 0 to 5% work its way through the system, and you're seeing that with the collapse of SVB Bank already. So it's happening in real time, and it's probably going to have the desired effect of reducing inflation, like what the Reserve Chair is wanting to achieve.
Yeah, I mean, yesterday we were talking about what it takes for us to understand if the banks that we trust with our capital are even stable. It's how do we do the due diligence on that? And that's just like you said. We're not economists, and at the same time, even as business owners, it's really hard for us to look at those banking institutions and say, hey, these are actually stable and well-managed establishments. Right.
So that the run on banks it's as old as time itself. It's been a problem when you don't have enough deposits. But I do think you're seeing a lot more people talking about the Dodd-Frank era since 2008. People learnt, they've got more liquidity on hand. SVB is its own unique beast in what it took out in terms of its treasuries, and then the treasury, all that sort of, it all went up in value, which eroded the value. So it all went up in interest rates, which eroded the value of the treasuries that they held, but I'm having conversations with the banks that I bank with, and like, hey guys, what's your liquidity right now? How much exposure do you have to crypto? How much exposure do you have to the tech world? Given that we're a real estate company. So we're having those real-time conversations, and also putting things in place, like setting up bank accounts in other banks. That doesn't just happen overnight, where you can quickly transfer money very quickly. And again, but then I'm adding to the problem of people pulling their money out too quickly. And there's some analysts that are saying that SVB might have survived. It wasn't, 2008, we didn't have mobile phone banking where we could, at a drop of a hat, transfer $50 million, and everyone does it. So I think the speed in which those banks failed, given technology, is also another reason why I just, let's take a breath here. Let's see what's actually, where do our banks have the most exposure, where you're banking with today, and does that exposure bleed into your, losing money that you have with them? And I think the Fed did a good job, in my opinion, to quell the concerns of runs on banks by saying SVB and Signature as depositors are protected. So we'll see what happens. Watch this space.
Yeah. Watch in real time. We will watch it unfold. You just mentioned another thing that I think is really interesting, because you mentioned that technology kind of amplifies when something might break down in terms of the timing and everything. And now there's more and more syndicators who are bringing the blockchain, the fractional ownership of a syndication to the markets. And I'm wondering if this is actually a good thing. Me being, I would say, a rather conservative, I'm not too fond of technology and like the fast-paced thing. I like it when it actually improves lives, but I'm not like a cutting-edge kind of guy. And I was thinking about how that plays out for us as real estate investors. And I actually think it will bring instability into a rather stable hard asset market when people have the ability to go into secondary markets and trade their ownerships or their part in a syndication. What is your personal take on that?
Yeah, look, I think you've seen it play out in real time a little bit in the fact that crowdfunding, right? In 2012, with the Jobs Act that changed, you saw a massive flight to market of all these crowdfunding websites. Raise money, invest as a pool, and I personally said, I'm being in the crowdfunding space because I'm technically crowdfunding because I raise money for my own deals. It's still a hard slog, and I just don't think there's that cruising around on the internet late at night, investing $100,000 here and there without having more due diligence, right? I'm still having, I just mentioned before coming on this call, like I was just on a call with an investor who's doing their due diligence on me before they invest in a deal. The idea of the crowd is great and has created a lot of power for people to choose where they invest and how they invest, and then allowed more diversification rather than going, history, with like the old boys club and, commercial deals were done, at the country club. It's now bringing a lot more power back to the individual investor. But I think there comes a certain point where, because of the check size, $25,000, $50,000, $100,000, you're just not seeing the quick cash like you would see in the stock market, right? Creating a stock market out of hard assets, I think is, at least in my opinion, I think people are trying with the blockchain, and look, good on them if they can. I haven't even delved into that world, but just from the people that I talk to, my investors, they want to get a sense to know who I am, who's the operations, because at the end of the day, it's a physical asset. It requires work to run these buildings. It doesn't just happen overnight. So that in itself, no amount of technology can replace that. And so I think the sentiment around being tech around syndication has there's sort of a ceiling, in my opinion, just because of the sheer volume, so the sheer size of checks that are being used, written for everyday deals. Yeah.
But I think there is a different generation of investors coming up. And I think we've seen it a little bit playing out with the way retail invested in the last 2 years, especially when there was COVID and people were home. And I think some of that might move into the blockchain syndication space. And I'm interested how it's going to pan out. I'm not necessarily excited about it while I'm learning about it, because you cannot roll back technology. Just like you said, rents develop a certain way, prices develop a certain way. Once technology is there, it's usually here to stay. It's very, very few things that are being rolled back on. So I think that's something to watch. But at the same time, I think there is a space for people like you and me who, work on the more traditional, like handshake, trust, building relationships with our investors. And yeah, that's how we like to do business.
Look, I think in general, the real estate, from a tech space, everything from leasing to raising capital, and just think of title companies, how archaic that is, and doesn't even exist in probably Europe or Australia, but they exist here. So it's so weird. It's still very much the wild, wild west when you compare it to other spaces, other industries, right? It has not been teched in that sense that so many other spaces have. And I think there will be a limit to that. Like, think about entitlements, think about building new things and getting city approvals. I don't know how much technology is going to change the fact that I still need to go down the city and get approvals from the local city board to build a 200-unit building in downtown Dallas. Like, there's just things that will, as humans, we can't avoid, and tech won't just solve it all the time. they still have to roll up the sleeve and do some hard work at some point, in my opinion.
Yeah, I agree. And I don't think those kind of approvals will go into any software soon. Like, I mean, hopefully not. Like, I would like to be some humans to be involved in those decisions.
Right.
Well, Reed, this has been super interesting. One of my favorite questions at the end is, what do you consider a life well lived?
That's a good one. I think living, as Tony Robbins says, doing what you want, when you want, with who you want, as much as you want. I'm still in the building phase of my company and building my wealth for my family. And, there comes a point where, as an entrepreneur, I've got to also look at enjoy the fruits that I have, grown. But sometimes it's hard to in the hustle and bustle of it all, to stop and take a breath and smell the roses and consider where one has come from. But I do still hold true to that analogy that my North Star is getting to a point in my life where I'm doing all this investing and creating wealth for people, including myself, so I can have a life that's on my own terms, right? And that's what I enjoy. So yeah.
I like that. I think that's very much it, living life on your terms and being able to smell the roses.
When you want to, right? It doesn't mean there's no hard work and getting to the point, but I'm a bad employee because I didn't want to be an employee, and I'm always going to be a business owner. But it's there comes what's the old saying? You quit your 9 to 5 to work 24/7, 365 days a year. So, that's it's you have to be self-aware enough as a leader of a company to understand when work hard, but also when to take time off and recharge. And even as an individual, my wife tells me all the time, like, take a break. You're allowed to. You've earned it, so to speak.
Yeah. But I can relate to that. I much rather probably work twice as hard for myself than working on somebody else's. And there, I think it was Naval who said that once you had a taste of freedom, you become unemployable.
That's right. Correct. Yeah. I don't think I'd ever go back to a job, ever. So.
Well, awesome, Reed. Thank you so much for your time. Where can people find out more about you, connect with you, find your books?
Go to reedgoossens.com. It's reedgoossens.com. If you're ever coming through LA, hit me up. I'm on social media, Instagram, LinkedIn, Facebook. You can hit me up on those platforms. And DM me and we can meet up for a coffee or a beer if you ever come through LA.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.